I do think we've created a regulatory structure and a market structure that really makes it unattractive to go public until you have to. The reason these companies are going public now is because they have to. They have capital needs that are so voracious that it is not prudent for them to try to do 100% of it in the private market and not have a public currency. It's just not prudent. And that's why I think you're going to see a bunch of these companies go public, because they actually need the capital. It's interesting. I've advised companies for years. And at one point, 25 years ago, I actually ran the equity capital markets business at Goldman Sachs. That was a job I had early in my career in Goldman Sachs. And I used to say to companies, there are a few reasons to go public. You need the capital. You need the currency. You have to create liquidity for, early investors. But all the other stuff that people talk about is really not critical. And you have to recognize that if you're running a company successfully and you don't need those things, when you take it public, you will run it differently. You will run it differently. It is different running a public company than a private company. There are different pressures. There's different life cycle of how you have to respond. You will run it differently. And so my advice has always been, wait as long as you possibly can to go public.
Hello, and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
So, Joe, when we talk about AI
Yes.
and its impact on jobs
Yes.
and businesses, one of the things we like to do, or one of the prisms through which we like to explore AI, is through banks. Right?
Absolutely.
So you think about banks, they've got big tech budgets.
Yep.
They're talking to AI companies all the time. They're their clients, essentially. So they're deploying a lot of this technology. And then they have this whole array of jobs, right? You have the classic sort of process workers in the back office.
Yes.
You've got the junior analysts who are churning out PowerPoints, but you also have bankers in IB who are doing more, I guess, relationship driven business. So you have this really good cross section of the sort of white collar jobs that people think about when we think about AI disruption.
Do you remember in the 2010s when every bank CEO is like, we actually like to think of ourselves as a tech company?
I remember.
That was a fun
Bring
little...
in the ping pong tables for the engineers.
That's
that was
right.
it, right?
That was a fun little era. But no, you're absolutely right. And of course, AI is largely expected, at least until we have much more advanced robotics, expect to affect white collar labor first. You mentioned the whole range. But there are aspects of when I think about being a banker, working a bank, that, to your point, really do feel like, relationships. And like there's the cliche, it's like, go out and golf. But I think they do actually golf a lot. And I think that is part of the business.
All right, well, we'll find out. We have spoken to Marco Argenti at
Yeah.
Goldman Sachs before. He's the CTO, about
Yeah.
how the bank is actually deploying technology. But today, we have an even more perfect guest,
We have the perfect
if that's
guest.
possible. We're going to be speaking, of course, to David Solomon. He's the CEO and chairman of Goldman Sachs, and he just penned an op-ed in the New York Times with the headline, "I'm the CEO of Goldman Sachs. The AI job apocalypse is overblown." So truly the perfect guest to
Let's
talk
do it.
about all of this. David, thanks for coming on Odd Lots.
Thank you for having me. I'm delighted to be with you guys.
Congrats on the op-ed. You're in the media industry now.
Well, I'm trying not to be in the media industry, but I'm glad I wrote the op-ed. By the way, not my title, the New York Times title,
Yeah.
the New York Times title. But I'm glad I wrote the op-ed.
Why did you write it?
Well, I wrote the op-ed. I haven't written a lot of op-eds. I think in my
Yeah.
8 years, I've written 2. And the last one was back in 2019 before COVID. And it was around energy, where I was trying to talk about the fact that I thought there was going to be real change in the context of the energy supply chain. And it was very important that we made investments in things that were greener, and we moved in that direction. But I also stated at the time, and took a little heat for this very emphatically, that oil and gas was going to be a significant part of the energy supply chain for decades to come. And
Good call.
Goldman Sachs would be financing, fossil fuel companies for a long, long time. And in looking at the lens, now I think that it is very important that we have a thoughtful and detailed discussion about the change that's going on. And let's just start, if you don't mind, if I can step back. I am hugely optimistic about this technology and the impact that this technology can have on large scale enterprises like Goldman Sachs, and the productivity gains that it can create, which I do believe can increase economic growth, create more prosperity, and more impact on our economic system broadly in a very, very positive way. I am hugely optimistic. And I think about things in 5 to 10 year, time bites. Like what should we expect to see over the next 10 years? That's the way I think about things when I make a statement like that. At the same point, I'm extraordinarily cognizant about the fact that it's not going to be a straight line.
Yeah.
There's going to be disruption. There are going to be jobs displaced, as there have been with any other technology acceleration over the course of history. And, we as an important company, and governments also do too, play a role in, thinking about what's the best way to make this go as well as possible, but with the ultimate goal of having the technology make our society more productive and therefore allow for more economic growth and more participation by everyone. And I was listening to a variety of things that were being said, and they didn't really make sense to me. And I thought it was important for Goldman Sachs to get into the discussion. And so, there are things that are always different, but I generally, if you want to talk about kind of fundamental principles that I have after 40 some years of doing this, it's never different this time. Meaning I don't think we're going to wake up in a world where nobody works and there has to be universal basic income and we have massive unemployment. I just don't think that's the way our economy works. And when people start talking about those things or postulating about those things, I don't think they're being thoughtful about really looking in a granular way at the labor force and how job creation works in our economy and how technology disruption in the past has changed and shifted, the nature or the makeup of labor and the economy in the U.S.
I think to even begin the discussion of will AI cause a white collar wipeout, or as you did say in the op-ed, some areas will really change and headcounts will change. But to begin this conversation, you have to know what is a job? What does someone actually do at their job? And so I don't know, maybe this is a chance I'll let you butter you up, let you brag about yourself for a little bit. I saw a quote, I was doing some prep, and you were talking about early in your career and going from Bear Stearns to Goldman. You said, I was a big producer at Bear Stearns. I built a lot of relationships there and brought a lot of relationships to the firm. This is the part where what made you good at your job? What was there were a lot of people there at Bear at the time. You eventually became the CEO of Goldman Sachs. What was it that the skill that you've had or that successful people in that role had that made them do their jobs well?
Well, finance has evolved. I started in 1984. I recently referred to that as the prehistoric days of finance, when, by the way, I had long flowing hair. It was just a very different world. And so let's just start with the fact that finance was a relatively nascent industry and also had been relatively stagnant for 15 years. Because we really went through a period from the late 60s to the early 1980s where interest rates were going straight up.
Yeah.
September 15th, 1982 is a very, very important day in the history of financial markets because that is the day that the 10-year Treasury hit 15.9%. And it also happens to be, a little less than 2 years before, I landed at the Irving Trust Company at One Wall Street to start my career. And at the time you got trained to do analysis, but the business was very entrepreneurial. There was very little structure, and there was so much open running room, to go out and participate that young people, especially when you got away from the most white shoe firms, which at the time were Goldman Sachs and Morgan Stanley, were really encouraged to go make their way. And so I was working at Irving Trust. And this was a time when almost everybody in finance went to business school. I was applying to business school in 1985, and I got a job offer to work in the junk bond business at Drexel Burnham. And I decided to take it because it appeared lucrative, and my dad
Junk bonds were the only thing taking off, basically, in finance in the early 80s, right?
It was definitely an area of finance that was accelerating, and it was very entrepreneurial. And I said to my dad, this is taking a risk because everybody else is going to business school. And my dad said, go try it for 2 years. If it doesn't work, you go to business school in 2 years. I mean, it was a pretty good advice. It was a pretty simple, piece of advice. But I went to Drexel Burnham. It was very entrepreneurial. And the culture, there were good things and bad things about the culture at Drexel. And some of the bad things are the reason why in 1990, on February 14th, 1990, Drexel Burnham went out of business. But as many other Wall Street firms have in the history of Wall Street. But, for the 4.5 years that I was there, basically I was told, go find a way to build relationships and make money. Go find a way to build, I was 24 years old. Go bring business into the firm. We sat at a desk. I golfed a little bit, but we sat on a desk and we called people and talked to people. And it was a time in the world when if you picked up the phone and called someone, you would get them on the phone and you would talk to them. And if you were an effective salesperson, you could do a lot of business. So
to some extent, you were like good at sales. You were good at making that call.
One of the great experiences I have, this is an experience I've talked about a little bit, but I haven't talked about a lot. But a seminal experience in my personal development was the summer after my freshman year in college. I got an internship in a Merrill Lynch office. It happened to be the office that was at I think it was like 10 Penn Plaza. It was by Madison Square Garden. And I got the internship because I was my high school girlfriend's father ran that Merrill Lynch office.
That always helps.
And and he said, why don't you come and do an internship for the summer? And I said, what would you do? And he said, you'd call on clients. I really had no idea what he was talking about. So I show up at this Merrill Lynch office and they plop me down and they give me a zip code list. Okay, basically, and it was the zip code was 10028 and 10128, basically the Upper East Side of Manhattan. This is 1981, okay? They give me a zip code list and they say, make 100 phone calls a day and ask people if they're interested in talking to a Merrill Lynch broker. And during the course of the summer, okay, for 8 weeks, I made 100 phone calls a day. I got 5 people to talk to a Merrill Lynch broker, and we went and had 1 meeting and opened 1 account.
Oh my God.
Okay. It was brutal. And after the first week, I said to my dad, I was like, I don't know that I can do this for the whole summer. And he said, yes, you can. You took it on. You got to finish it. And I started thinking about, and this is the seminal thing that I'm trying to point to. I started to think about how am I going to make this more fun, because it is very difficult to cold call. Now, this was a time when people would answer the telephone, and I just started making it a game. But what did it teach me? It taught me to pick up the phone and talk to anybody. And when I got to Drexel Burnham, and here there were real financial incentives for picking up the phone and talking to people. I mean, they weren't paying me anything, and they just wanted me to do this, and I was doing it to learn. You put financial incentives in place, I found I could call anybody. I could get people on the phone. I could keep people on the phone. I could go see people. I could relate to people, even though I was very young, and I could bring business into the firm. And very quickly, I became good at that. And when I arrived, at Bear Stearns after Drexel Burnham went out of business, I very quickly became a very significant producer in a culture that was kind of eat what you kill. And it was a great experience. I don't think it was the perfect culture. And
Sure.
Culture's evolved, but I do think there's something here. And one of the things we're talking about a lot at Goldman, I think it's really important. I still think human-to-human contact matters a lot. And I think one of the great opportunities we have with this technology expansion is to get our young people out with clients, talking to clients, broadening our client footprint. They're incredibly capable. This shifted over the last 30, 40 years. And it really, I don't think it shifted for the better. And now we're going to shift it back. And I think it's a real opportunity.
Wait, say more about this, because in your op-ed, you talk about the Stanford data showing like a 16% decline in entry-level hiring. So this is something that's happening right now. And presumably a lot of the work that, younger analysts at Goldman Sachs do right now could be commoditized through AI, right? If I'm building a PowerPoint presentation, I no longer need like 10 analysts to stay up all night to do that. I can just generate it through a platform. So how do you see the role of junior analysts, and then how do you, I guess, train the next generation of banking talent at Goldman?
I think that's a really, really good question, and I want to get to that. But I just want to comment on one of the things that you said that I think is a really interesting thing for us to think about, because I did quote that statistic, but I think it's important for us to think about and see that statistic for what it is. Okay, because when I graduated from college, it was very, very hard to get a job, but not everybody wanted to get a job. Okay, in the white collar professions that are defined by the 16%. But I'd also argue even today, if you graduate from a liberal arts college and you want to go be a school teacher, okay, that's not counted in the 16%. Okay, there's not a decline. What they've done is they've taken a handful of industries that they're looking at that fit this kind of social narrative of what the right kind of job is when you're coming out of college. Okay, which by the way, I think is a very faulty lens to look through. And that group is declining by 16%. Okay, but what if you graduate from college and you say, you know what? I really think I can do something really cool and entrepreneurial by making the world's best sub sandwich. I'm going to go open a store and start a sub business and try to grow a sub business. And over the next however many decades, you grow a huge sub business.
Joe used to be in the sandwich business.
Were you in the sandwich business?
The sandwich
after
business.
College.
That's a nice way of saying I had a job at a deli.
There are so many, but there are so many different things you can do. I've got great friends I went to college with. I have one friend that I went to college with that basically graduated from college. He had studied science, physical sciences, and he decided he wanted to be an electrician. And he had his own electrical business in upstate New York, where I went to college. But then ultimately he got pulled into, other kinds of businesses where the skills he had developed over 10 or 20 years, building his electrician business could be put into other, things. And his career evolved. And so, there's a narrative about jobs and entry-level jobs and what I mean. I don't even know what it all means. What I know is you want to be a learner through life. You go to school to get educated and to broaden yourself and to meet people. Not everybody should go to a traditional school. There should be lots of different paths. But the goal is to start on the journey of figuring out what you're passionate about, what you enjoy, how you're going to make money, how you're going to support yourself, how you're going to support hopefully the family that you have. And there are lots of different paths. There are lots of different paths.
Okay, but assume that we're talking about someone who wants to get into Goldman
out
of college.
Yeah. And I don't mean to pontificate about that, but I think it's a really important thing, because this goes to the op-ed and kind of the labor force. There's a lot of the labor force that has nothing to do with what we're talking about. And I think that's something that we've got to keep coming back to in the discussion. So, coming out to Goldman, coming to Goldman at this point in time, we hire, we just right now, okay, we just have 2,500, it might be 2,400 interns starting.
Wow.
And in July, we have approximately the same number of permanent, new hires that are starting. The first thing is there are a bunch of them that are in, quote, client-facing jobs and roles. There are a bunch of them that are in operational roles. There are a bunch of them that are in technology and engineering roles. I mean, there's a wide range of jobs. I mean, there are a couple of them that are working in marketing, okay, and advertising. I mean, there's a wide range of jobs. All the experiences are different. All the opportunity sets are different. When I was talking to you about out with clients, I was talking about the people that are in the client-facing roles. And, one of the things I truly believe in, look, I see this. I sat with a group of venture-backed founders at dinner in my apartment the other night. The average age was like 28. So impressive, so smart. By the way, the people we're hiring at Goldman Sachs are so impressive, so smart. They're peers with these people that are going and starting businesses. They can't go out and talk to clients and have an impact. And so with the technology, it makes it more leveraging. I mean, I think you guys saw it, because I've used this example of when I started doing a common stock comparison, took 6 hours, go, microfiche, Wall Street Journal, the only source of historical stock prices, put it on graph paper, take a picture of it. If you really think about that example, what that example is actually saying is, if you were a company and you wanted to know where your stock was trading during the day, you had two choices. You could call, or three choices, I guess, technically. You could call your investment banker and say, hey, where's my stock trading right now? And the fact that we had a Quotron, in our office, okay, we could tell them. They didn't know. They didn't have a Quotron. Or you could call your stockbroker if you had one, or go outside your office and find a Merrill Lynch or an E.F. Hutton or a Dean Witter, office on the street and look at the ticker tape and wait until your stock would buy on the ticker tape. Okay. Or you could wait until the next day and open up the Wall Street Journal and see where your stock traded that day. So we were offering a huge value service by simply having this technological machine that allowed us to tell them where their stock was trading. So if you think about what young people were doing when I started, a lot of what we were doing was taking very primitive technology and giving information to people that were trying to run their businesses. And the pace of everything was very, very slow. We've now, over 40 some years, accelerated that enormously. And so the productivity level of all these people is going up, up, and up, and up. We haven't had fewer people. Now, maybe this technology is accelerating in a way where over time we will actually fundamentally have fewer people. But what I would argue is the real challenge for us is we've got to find ways to apprentice them and teach them a variety of things that they're not going to intuitively learn because they don't actually have to work as hard to get the answer. When I had to go to the microfiche and look at the different stocks and see how they were trading, actually put it on graph paper and absorb the differences and do the math to explain what the percentage compounding differences were, I was learning something.
Yeah.
That now, if you ask for it, you get it instantaneously. Has your brain really absorbed what's actually happening? And so the challenge is, how do we apprentice and give people the base of knowledge, but how do we also allow these tools to allow them to get out into the world so that they can really have a bigger impact faster? And we don't have the answers to this yet, but we're really thinking about that.
So just like two sort of short job related questions. First one is, you can almost yes or no. It's like those skills that you had, you were very comfortable picking up the phone and so forth and getting maybe people to answer. Just today, if someone is there a role for that person still? That same
definitely.
Basic? Okay,
definitely.
that's
by the way, I don't think that's going to change. You guys can go look. I gave a commencement speech at Wharton, last month, and one of the lines in the commencement speech was, the telephone is one of the greatest pieces of technology in the world. Use it. A telephone call to someone is 10 times more valuable than a text or an email. My daughter says that's an unverified statistic, but I know that's true. And it is. If I call you personally on the phone, it's going to have a completely different impact than if I sent you a text or an email.
But I don't know your number. I'm not.
I would also accept a text from David Solomon.
Just as the follow-up, and this is more of a sort of specific.
That's not going away. I mean, I really believe, Joe, that's not going to go away.
Of that mix of new hires, the range of jobs, including engineering jobs, can you identify, is there a change different between today and 2026 versus, say, the pre-ChatGPT era, 2021?
Well,
in terms of, have you seen a difference yet, just in terms of, the allocations of anything with any hiring decisions so far?
Subtle changes, but you can't look at it in a vacuum. So you said to me I can be very detailed with you.
Please.
I think, I think with all this stuff, it's nuanced. Details matter. If you look over the last 10 years, I'd say what's happened is the amount of engineering talent we had at the firm grew materially on a relative basis to operational talent or client talent. Okay? There are a variety of things that happened because of the pandemic that bloated or inflated hiring across all large enterprises.
Yeah.
And so if you say, since ChatGPT, if you take 2022, that was like the high watermark of the bloat.
This is the problem.
The high watermark of the bloat. The high watermark of the bloat from COVID. Yeah.
Historians will be vexed by the confounding variables of 2022 for a very long time.
Absolutely. So if you ask me a question and I'm like, okay, 2022. Yes, but that's the wrong starting point.
Okay.
Because if you look at 2022, a bunch of what we've done from 2022 to 2025 and now in 2026 was correcting the stupid things that we did in 2020 and 2021. And so I think you've got to look at it through a 10-year lens. And what I would say is at this point, if you look at a 10-year lens, it shifted to more heavily weighted engineering. My guess is that's going to shift differently going forward, given the power of these tools and our ability to code. And you're going to see nuanced changes that probably to some degree reduce the number of people that we start with over the next few years, but probably not what you and I would call dramatically.
Okay.
So I don't want to be, predictive, because if I throw out a number, here everybody's going to start holding me to the number. But, I just told you we were running it at 2,500, which by the way looks similar to what we were running at pre-COVID.
Okay.
But lower than the 3,000 plus we were running in 2021. Okay. My guess is it's going to be in the next 3 years that will contract a little, but not in a way when you and I would say, wow, this is a huge, huge change. We're still going to hire a lot of people out of school.
I mean, aside from potential headcount reductions and cost savings, how do you actually measure productivity gains at Goldman?
That is a great question, Tracy. I can tell you some examples of things we're doing where I know we'll be able to quantify some significant productivity gains, but they're more in the category of remaking operating processes. So what we're doing under what I know you guys have read about 1GS 3.0. So if we redo our client onboarding, anti-money laundering, KYC processes, and we had a process that had 3,800 people touching it, not 100% of their job, but touching it, and now we'll have a process with a few hundred people touching it, that's a productivity. When it's done, I can measure the productivity gain of that process, okay? That's different than saying to me, okay, you've got a bunch of people who work in investment banking, okay, how much more productive are they? Now, one measure is I can look at the revenues we have in investment banking and the earnings in investment banking and the number of investment bankers we have and the amount of capital we allocate to that business over the last 10 years. And you know what? Our people are more productive because we're making on a per person basis more revenue, more profit on a per person basis, but we definitely are allocating more capital to the business, and the capital is helping and creating leverage. But there's no question they have better tools. They can do more. We've found ways for them to do more. We also have collaborative power going on inside the firm in the context of 1GS 1.0 and 2.0 that are adding to revenue growth. It's very hard to pull it apart, but I think every 5 years we can directionally say, is it more productive? Yes, it is, because you go back when the firm went public, the firm had $6 billion of capital, I believe, and we had 16,000 people, something like that, order of magnitude. Today we have 45,000 people and $110 billion of capital. The firm is much more productive against producing reasonable returns on that capital than it was 27 years ago. I mean, that's clear, but that's a 27-year look, not a year-to-year-to-year look.
AI works when there's access, when there's a lot of data, pooling together a lot of unstructured data. When I think of a firm like a Goldman Sachs or maybe a law firm, et cetera, there's always a little bit of I suspect, an alignment problem where maybe the big producer doesn't want to share all their data with the rest of the firm, doesn't want everything in their head just to be in some big knowledge pool that everyone has access to. You might want to be able to take your book of business to a rival shop every once in a while. That's probably always been the case, but I think it's probably a bigger deal with AI because AI could in theory really leverage all of that latent knowledge that exists in a lot of people's heads. How do you think about getting a firm-wide understanding of what's truly known and understood within many people's heads so that you can really maximize this technology at a time when, again, it might make sense for at least some relationship players to keep a little bit of knowledge inside their own head?
Well, it's an insightful question. And I'd start with the fact that one of the things I'm really proud of about Goldman Sachs is Goldman Sachs is less what you described, I believe, than any other firm.
Say the other one, sure.
I think that we really have, for a long time, it's been part of the culture, but we really have a culture of sharing and collaboration. It is not a star system. People share. It is it's just such an ethos at Goldman Sachs that I think we have less of this problem than other organizations have. But what's interesting to me about your question, and it makes me really think about it, is it's something that I deeply believe that you started with, and I'd frame it in 3 buckets. This technology is incredibly powerful when you have a clean data set.
Yeah.
Put these models against a clean data set, it is extraordinary. Like, it is mind-blowing to me what you can do, the speed with which you can do it, the information that you can accumulate, and how powerful that is when you have a clean data set. It wouldn't surprise you, Goldman Sachs has an extraordinarily amazing data set that we're working very hard on to make as clean as possible on everything we've ever done from a trading and investment banking perspective over the last 40 plus years. We happened to build a system 40 years ago called SecDB that was a trading system. So we have data from all our trading that goes back long before most other firms kept data on this stuff. And so we're working very hard on that. But these tools, extraordinary when you have a clean data set. When you don't have a clean data set and you send them out into the world, you get really, really cockamamie answers. Let me give you a simple example. Just tell a story from a few weeks ago that was another one of these data points for me and really understanding how this all works. It's pretty simple. I was down at the Masters and Rory McIlroy was up by 6 strokes after 2 days. And I was like, holy cow, he's probably going to win twice in a row. How many people have won the Masters twice in a row? I know Tiger Woods has. Okay. I think Jack Nicklaus has. but I don't know if I can't remember if there's anybody else. So I asked one of the models, hey, how many people have won the Masters twice in a row? And the answer comes back, Jack Nicklaus and Nick Faldo. So I was like, oh yeah, Nick Faldo did win. But it didn't say Tiger Woods.
Oh, interesting.
So I said to the model, hey, I don't think you're right. Didn't Tiger Woods win the Masters 2 years in a row? Model says, wait 1 second. Comes back, yes, you're right. Tiger Woods did win the Masters twice in a row. Why did you get that wrong? I said to the model. Model comes back, well, I used this source. I did this source. The bottom line is not a clean data set.
Yeah.
Not a clean data set. Garbage in, garbage out. Now, human judgment had to look at that and say, no, I don't think that's right. So that's, are we going to get to a place where the data sets get better and better and better? Yes, but as long as one of the functions of the model is they go out into the internet and they go out into social media and they go out into the media and they go out into the world, there's going to be a lot of garbage in, garbage out. And the models can get better and better and better. But it's going to be really interesting to see over time how the models get better and better at distinguishing. And one of the things that's interesting is I then asked the model, hey, okay, will you search this differently the next time because wherever you went got it wrong? And the model said, no, that's not the way it works. Now, one day I think it will work that way and it will search it differently. But that's just interesting to me about where we are. Here's the third thing, okay? You were talking about what's inside people's heads.
Yeah.
I personally believe the answer to this is never. And this is one of the magic things about humanity. This is one of the magic things about creative things. And by the way, part of investment banking and client relationship is creative. It's EQ. It's emotional intelligence around spending time with people, how to connect with people, how to build trust with people. Okay? Machines can be really, really good. Tools can be really, really good. But unless you're in the camp that humanity is not going to be about trust and relationships, I think this is like a never thing. And so the bridge is how to use the tools, okay? And with the tools, leverage more of your humanity and your connectivity in a special way to be more impactful with people. Now, here's an example that I think is an easier example to kind of look at. And I have a daughter who's a screenwriter. I've talked to her extensively about this because people talk when somebody writes about their voice, okay? And one of the reasons why, if you really understand the process of writing a movie, okay, sure, can AI write a script? Absolutely. But the first thing is that script is, if my daughter's the screenwriter, it is not in her voice unless that model has access to every single thing she's ever written, every single experience she's had in her life, every single emotion she's ever felt. Never going to have that. And so voice matters when you're writing or you're doing something creative. Now, here's the thing. She puts her voice on whatever she writes. Now she goes to the studio. The producer says, I don't like this. I don't like that. That's a personal feeling. He's not asking the model to say whether I like it or I don't like it. He's reacting to it emotionally because it's creative. It's like relationships. I don't like this. By the way, somebody came in and pitched an investment banking deal, and the CEO said, there was just something, I just didn't like the way that guy talked to me. Okay? That's a human emotion.
Yeah.
That matters. That's not going to change. And so this concept of getting things out of people's head, what you're really talking about is human intelligence, humanity, EQ. And I think we're going to figure out how to use these models more powerfully. The data sets are going to get cleaner and cleaner. Yes, maybe we'll expand better into the second and clean up when you go out in the world. But when it comes to the way human beings interact, I actually think this is a superpower that's going to get more valuable and more valuable and more valuable. And it's something we want, I think people should think about, people should try to learn. I think public speaking still matters. I think writing is still going to matter. I think how you communicate and talk to people is going to matter, how you spend time with people, how you build, all this stuff's not going away.
All right, so Goldman Sachs bankers should be social maxing, I guess.
Yeah, that's right.
Social skill
this
maxing.
Is the headline.
Well, by the way, the most successful people at Goldman Sachs have extraordinary interpersonal skills.
I believe it. We interviewed Lloyd Blankfein a couple months ago, and Lloyd, he's a
We
funny
always
guy.
laugh.
He's
Yeah.
super funny.
Yeah,
it's
he's
just a fun
really
guy.
funny.
Super funny.
You're a fun guy too.
No, I'm
Yes,
not
you
as-
too.
I'm not as funny. I'm really not as funny. I mean, he's much funnier than I am.
You mentioned looking up share prices earlier on the Quotron machines, and speaking of share price, your stock recently crossed $1,000.
New
Goldman
all-time
stock.
high.
an all-time high. So congratulations.
Thank you very much.
On that. My question is,
Great
how
career,
often do you look at the share price of Goldman Sachs? Is that like the first thing you look at when you wake up in the morning?
Well, I don't. It's not the first thing I look at when I wake up in the morning because I looked at it when it closed the day before.
Oh.
So it generally doesn't change overnight. Look, when the stocks, during the week, I would say I look at the stock price, most days during the week, but it depends on what I'm doing. If I'm in the office, if it happens to be a day when I'm in the office going from meeting to meeting, and in between meetings, I jump on my desktop and I'm responding to emails or I'm making telephone calls, the screen's up. And I'm looking at our stock price, but I'm looking at I'm trying to look at what's going on in the market, have an absorption as to what's going on in the market that day. If it's a day where I'm in a bunch of meetings and I'm on the road, I might not look at the stock price at all, but probably at the end of the day, I'd look and say, hey, what happened today? And by the way, it's not just our stock price. It's actually what happened in the market today. For me to be effective, I have to be super in touch with what's happening in the market, every day. And I spend time on the weekend also catching up on it. From my perspective about our stock price, of course, it's human nature. I'm going to look and see, but what I really care about is kind of year to year to year. And what I really believe deeply, and it's been one of the things our leadership team has really been focused on for the last 8 years, is if you grow the earnings of the firm, if you invest in growth in the firm and you grow the earnings of the firm, the stock will do just fine. The multiple will move around, but if you grow the earnings of the firm, the stock will do just fine. And so we've been focused on investing in the business and growing the earnings of the firm. And we've grown the earnings of the firm materially. We had our first investor day in January 2020, and we put out a plan, and we've been executing against that plan. And since then, we've grown the revenues of the firm, 65-ish%. We've grown the earnings of the firm about 140 to 145%. And what do you know? The stock's reacted really well. And we've gotten a little bit of a better multiple because it's a much bigger, more diverse, durable business. The durable revenue nature of the business is better. So we're getting a better multiple, on what we're doing. But I'm super excited because I now look ahead for the next 5 to 10 years. And I look at this technology and our ability to remake operating processes and take the most productive people and have them spend more time with clients and broaden our client footprint in areas like wealth management, et cetera. I'm like, wow, we can really grow the firm. We can really grow the firm and grow the earnings further because we're going to have more capacity to invest in growth. And so that's super exciting. And so it's been a journey. I mean, when I started, the stock was around 200. Now the stock's over 1,000. By the way, it could go back, but it's not going back to 200. But the stock can back off, the multiple come down, our earnings could slow if we went into a tough economic environment. But fundamentally, the firm is bigger, broader, more diverse, more durable. And I think on a super course, for more earnings growth and more performance for our shareholders over the next 5 years.
So the performance is objectively strong, but no offense, you can see a lot of charts right now in the market that are going straight up and to the right.
Absolutely, but the important thing, and I know you know this, Joe, the important thing is to look at the relative performance
I know.
and the relative performance.
The
relative performance over the time we're talking about is top of the heap.
Totally.
And we're going to keep driving to try to deliver that.
But I got a sort of a capital markets question for you that sort of maybe as a banker you might have some thoughts on. What do you make of, so connecting it to the AI conversation, what was your thought when you saw, or maybe yours had something involved in it, Google making an equity raise to continue? That was interesting because there's been a lot of debt financing from the big tech companies for the AI build out, which we could have done a whole episode just on that. What do you make of a company that big doing an equity raise at these levels and even doing like a private placement? When I asked ChatGPT, and it could be wrong, as your example with Tiger Woods noted, when I asked about comparables, like what other big companies did these private raises, they're almost all crisis era Berkshire investments, including one in Goldman. But what did you make of that? Google doing an equity raise to finance rather than a debt raise?
Well, there are a couple of things to think about here. But first of all, I know a little bit about this.
Yeah,
and there's some things I can talk about and some things I can't. But I think that the firm ran this whole process, and the firm was the only bank that was involved in this for the last 5 months. Up until a couple of days ago when other banks, were brought in to participate. Okay. But the firm ran this over the last 5 months. This was Goldman Sachs' deal, and the team, that was led by Yasmin Kupal and Kim Posnett and David Ludwig, runs our equity capital markets business, did an extraordinary job. This is one of the largest, if not the largest, secondary follow-on equity offering ever. Yeah. And we're ultimately, if the green shoes exercised, we're going to raise 85, to 90.
It was up this just morning from 80 to 84.6.
Yeah, we upsized it, and the green shoe, my guess is, given the way the stock's trading, will probably be exercised in the coming days. And so they raised $90 billion. And so it's really extraordinary. And by the way, I think one of the interesting things to think about, this is the first concrete, tangible data point on investor demand at this scale. And we have some other things coming up at this kind of scale and so this is a very important tangible investor data point. And I think one of the things that's very helpful to the firm is sitting in the middle of this. We got a lot of information on how investors are thinking about all this and the others that I think is super, super interesting for us. But this is, it's unprecedented in its scale, and it's reflective of the fact that we now have some of the largest companies in the world that have capital plans over the next 5 years that are very, very significant. And they can fund a lot of it with debt. But I think you're going to see, and Alphabet is the first one to make this decision, I think you're going to see a bunch of them fund a bunch of it with debt, but also raise more equity, because they're starting to think about, okay, what does this look like? It's one thing, what does it look like this year, but what does it look like over the next 5 years? How much capital do we need? How much debt? Equity markets are good. Our multiples are pretty high, given the way the market's responding at the moment. We've got to think about our leverage going forward. The capital's available. And so the analysis is, and this is not all public, but in specifics, but I'll talk generally, a company has to look and say, not just what's our 1, 2, or 3-year capital plan, what do we think our capital plan is over the next 5 to 10 years? How's that going to change our leverage? What if there was a change in the market multiple, okay, and our leverage is up? How are we going to feel about that? And it requires kind of a long-term conviction on what you're doing from a capital deployment standpoint and making the decision as to what makes you more comfortable in kind of the leverage and balance between debt and equity. I think you're going to see more companies issue equity because, this is not, capital's available, and you want to be cautious about this. If you get it wrong, if you totally rely on debt and you get it wrong, you will really regret if you wind up having a downside scenario that's tougher than you expected. So I think you can see more companies, think that through. And Alphabet's the first company to step forward. Our team, spent a lot of time, over the last 5 months, really helping them think through these kinds of issues. I think they were very smart to really think it all through.
Well, speaking of equity raisings, you got the lead on the SpaceX IPO. So again, congrats on that.
Our team, really the team on that, really, really extraordinary. Dan Dees, Kim Posnett, just really Susie Scher, really, really extraordinary partners of the firm who just done an extraordinary job over years. Over years.
I imagine this was a very competitive process, right? And you were talking a lot about the importance of relationships earlier. Using SpaceX as a concrete example, what does that relationship actually look like? Is it true that you were, sliding into Elon Musk's DMs to pitch yourself? What is it that you offer to a potential client that other banks can't offer?
Well, there are things that I'm willing to say and try to give you some perspective on it. But the most important point that I could amplify about this is we didn't win this in the last 6 months. We won this over the last 20 years.
Wow.
The decision wasn't made. The decision wasn't made until the last 6 months. And there's a lot of things that the team did over the last 6 months that contributed to the ultimate result, which, by the way, now we have to execute. But this is a cumulative effort of lots and lots of people over 20 years. And we first, as a firm, we first met Elon Musk. And the person that first was responsible for covering him was a guy named Stuart Bernstein, who was doing a bunch of stuff around, kind of green energy. And he and his brother had Solar City. And that's where we first connected with Elon. And then, we took Tesla public when Tesla went public. Sometime around Solar City and Tesla, I first met Elon. And so I've known Elon, for more than 15 years. Dan Dees, Stuart Bernstein kind of semi-retired from the firm in the early part of the last decade. So let's say 2012, 2013. And Dan Dees, who now runs our global banking and markets business, was an investment banker who was just coming back to the U.S. after having been in Asia for a long time. And he was basing out of the West Coast and running our TMT banking business. And he started building a personal relationship with Elon. And Dan has built a really, wonderful dialogue with Elon over a long time. But it's not a straight line. And there are times, where we're doing things and we're not completely in sync. But at the end of the day, as a firm, we've been long-term committed to Elon, his companies, his teams, by the way, in this situation, Brett Johnson, the CEO, is a hugely, hugely important guy. And we've had people spending time with him for years and years and years. And, that's what our business is. Our business is building trusting relationships over time with people, giving the right advice, taking a long-term view, not being transactional, and trying to earn trust. So when the biggest, most important things happen in the world, we have a better chance of being asked to provide services. And that's kind of what we do.
Did you send him a DM?
So with respect to the DM, it is unfortunately, it's untrue that I pitched Elon via DM about the deal.
Okay.
But what is true, and this is the way facts get confused, Elon, some point in the last year, stopped taking texts on his phone or emails and started telling people that he knew that if you wanted to get in touch with him, direct message him on X. And so because I have a relationship where I reach out to Elon and we exchange messages about a whole variety of different things, I stopped sending him texts on his phone and started direct messaging him when I wanted to.
This is how Joe communicates.
When I
This is
wanted to-
entirely when Tracy is
when I want to communicate, I started
late.
communicating. So I went back and looked at the chain,
Yeah.
on my X account, over the last 6 months, just to make sure I wasn't wrong about this when I saw it in the press. And I said to Tony, I don't think this is true. And I never asked Elon in a text message about the IPO. We focused on his team. We focused on the work that we had to do. And we're really proud and pleased to be leading this. And we're going to do everything we can working with the other banks to get the best result that we can for SpaceX.
So it looks like this year is going to be a year of mega IPOs. We had the private confidential filing from Anthropic. We'll probably get a couple others, et cetera. However, the much bigger story is still generally private capital markets have gotten so liquid that some of these very successful companies, they could, in theory, maybe never go public if they didn't want to. Do you think, some people think this is bad for capitalism, that a bunch of big companies are going to come in and that unlike the Microsofts and the Apples and so forth, where the broad public really got to participate, even if you were just an index fund investor in a lot of the upside, these companies are going to be coming at some of the biggest market cap companies in the index, and the public investor will not have caught any of the ride from the 500th biggest in the S&P 500 to the 20th, et cetera. Does this break capitalism? Is this bad for the U.S. or is this fine?
Well, I'm going to give you a conclusion first, and
Okay.
then we can try to dig in a little bit to the details, which I know you guys love to do. But I don't think this is going to think capitalism.
Okay. All right.
I think it's good for the
Red
U.S.
headline.
There
I think
goes
it's-
your headline.
I think
Joe.
it's good. I think it's good for the U.S. that we have the biggest,
By the way,
most important
breaking
companies in the
hot
world.
headline just moved down the terminal. Anthropic said to tap Morgan Stanley, Goldman Sachs to lead IPO. This just came out.
Okay.
So there you go. Okay. Anyway, keep going.
So I think this is good for the United States to have the biggest, most important companies in the world. When you talk about what's happening, there are a lot of complex things happening about why we have fewer public companies today than we had 25 years ago.
Yeah.
And this is a long-term journey around policy decisions and market structure over a very long period of time. The reason that companies like Microsoft went public when they did it, the size that they did, was there was no capital available to them other than going into the public market.
Right.
But it's not fair to say that, that investors got to participate, in everything, because it's not like there's more access for
Well, no
investors
one talks
today.
about the 900 companies that went to zero that
Yeah.
went public in the same year as Microsoft.
That's
or whatever. Yeah.
that's so. And by the way, that's another thing. Most companies don't survive. So it's just not, that simple. I do think we've created a regulatory structure and a market structure that really makes it unattractive to go public until you have to. The reason these companies are going public now is because they have to. They have capital needs that are so voracious that it is not prudent for them to try to do 100% of it in the private market and not have a public currency. It's just not prudent. And that's why I think you're going to see a bunch of these companies go public, because they actually need the capital. It's interesting. I've advised companies for years, and at one point 25 years ago, I actually ran the equity capital markets business at Goldman Sachs. That was a job I had early in my career in Goldman Sachs. And I used to say to companies, there are a few reasons to go public. You need the capital. You need the currency. You have to create liquidity for, early investors. But all the other stuff that people talk about is really not critical. And you have to recognize that if you're running a company successfully and you don't need those things, when you take it public, you will run it differently. You will run it differently. It is different running a public company than a private company. There are different pressures. There's different life cycle of how you have to respond. You will run it differently. And so my advice has always been wait as long as you possibly can to go public. Okay, if you're giving advice to companies. And I think companies have recognized the capital's been available privately at most scale. The liquidity's been available in a variety of different ways at most scale. The currency thing is tricky, but generally speaking, with these growth companies, they don't need the currency because they're growing, they're not doing M&A. And so I think you're going to see a bunch of these companies go public because they need the capital, because they've reached the scale and they have a demand for capital where they need the capital. I think the current SEC chairman is working on a variety of things that hopefully will take some of the friction, out of going public, which will help a little bit. But at the end of the day, given the way markets work and indexation and passive funds and ETFs, a $5 billion market cap company with an $800 million IPO is just, it's the discount associated with getting that going has been less attractive to investors. And part of the reason is because public capitals, but private capital has been available without a discount.
Yeah.
But that, by the way, that could be a cyclical thing. In other words, we could see periods of time where private capital will have a bigger discount. The public market will be more efficient. And then you'll see more of those companies come to the public market. But I think fundamentally, we're going to operate with fewer public companies and the companies are going to be bigger. I mean, that's the way the market structure has evolved.
Okay, so speaking of capital being available, which is kind of putting it mildly, the markets right now seem kind of crazy to me. And you were at the Economic Club of New York yesterday talking about markets being in more of a greed stage than a fear stage. Based on your Wall Street experience, and again, you mentioned you started in the early 1980s, have you ever seen anything like this? Does the current time period, I don't know, have a historical analogy for you?
Sure. In fact, somebody said to me recently, this is unprecedented. They were talking about 10 companies having 30-some% of, 30-some% of the S&P, waiting on a market cap base. And I was like, no, it's not unprecedented. How about the 1920s? How about the 1960s? How about the late 1990s to 2000? I made the comment yesterday at the Economic Club because I was asked about the way the stock market's running. And if you actually look at the whole segment, I said a lot more than that. And I actually said before I said it, I said, look, I'm going to say something, and I know it's going to create a lot of headlines. But I do think it should be said because I do think I'm seeing some of that behavior that I've seen before. And, people are worried about missing out on this technology boom, whether it's compute, whether it's storage, whether it's chips, et cetera. And so people are crowding in. And that's a greed thing because they want to participate in their fear of missing out. What I should have said, at that moment was all of that. But then I should have said, but, it's kind of interesting because if you look at the S&P 500, the top 10 companies, which, by the way, are mid to high 30s market cap, and those other three periods, the top 10 companies were also in the 30s. And one of the things I have pointed out to people is these top 10 companies actually have more earnings than the companies did.
They generate a lot of cash.
They generate a lot of cash. So that's something to observe. But what I should have said is the market multiple, the earnings multiple on the top 10 companies in the S&P, these are approximate numbers, so don't hold them to me directly. I actually looked at this morning because I thought this would come up. And so hold it as approximate. The top 10 companies are trading on forward earnings in the low 30s. Okay. In the late 90s, 2000 internet boom, those companies were trading at more like high 40s to 50.
Yeah.
Okay. You think about Cisco when its market cap was over 600 billion. So these multiples, are high, but the growth's pretty good. The earnings are real. Those numbers are on the high end of the distribution for sure, but not crazy. The other 490, are trading between kind of 17 to 20, which, by the way, 20 high side. When you add it all together, it's kind of 22 times forward. A lot of it's at 17. I actually think the 17 sounds pretty attractive if you think that all these companies are going to be able to use technology, not all of them will execute successfully, but be able to use technology to improve operating processes and create more efficiency and therefore faster earnings growth and more investment in their business, you should see over the next 5 years improvement in the earnings growth of that other 490. I'm talking on average. So is the market running? Yes. Are people crowding into a handful of stocks because they're fearing of missing out? Yes. That's what I meant about the greed versus fear. But this could go for quite some time because it's narrow. And on a historical context, it doesn't look like Polaroid at 80 times earnings in the 1960s. It doesn't look like RCA at an infinite amount of times earnings in the 1920s. So I'm not sure is the bottom line. I'm not sure, but there's no question for a narrow group of stocks, the market's really running. And we've got what's interesting to me is we have a lot of things going on in the macro with the war, with the oil shock, supply chains, inflation getting stickier that are going to have an effect. And, the market may absorb all that differently than it's absorbing it at the moment. At the moment, it's kind of brushing it aside.
Things can always get crazier, as Joe likes to say.
That's right. You're going to be involved in the Anthropic IPO. Congrats on that. Just between the three of us here. No one else.
Just between the three of us?
Between the three of us here. I know you're part of Mythos and Project Glasswing. And there's this cynical take. It's like, oh, they just released it to a small group because they actually didn't have enough compute, whatever. What have you seen? And is it really is it keeping your cybersecurity people up at night? Have you found a bunch of bugs that you didn't know about? Tell us, what can you tell us about
here's what I can say publicly. I think it's very important. These models are incredibly powerful. And I think it's very, very important that these companies that are producing these incredibly powerful models work collaboratively with the government and with the private sector to give people opportunities to understand, what these models can do and to try to continue to secure our critical infrastructure as effectively as we can. Do I think the process around this was perfect? No, but we're learning as we go. And I think there are a lot of things in the process that have been good and have been helpful. It wouldn't surprise you that just using financial services, for example, as the 8 largest banks are significantly ahead on cyber investment and cyber protection over the last decade than bank number 2000 that sits in the middle of the country in Arkansas. Okay. And the risk in financial services, it doesn't mean that there can't be issues for the biggest banks, and the biggest banks need to constantly think about this. We invest a lot in this and we're all over this. That doesn't mean we can't have a problem. We could. But the risk is that, a medium-sized bank has a problem and it creates fear in a broader group of medium-sized banks. And you don't have to look that far. If you look at SVB and how SVB had a problem and it created fear in a variety of banks, you could see a cyber attack at a mid-sized bank creating ripples through the banking system, which will be, dislocating. And so, I think it's really important that we figure out, how to help the broader business community get more invested. And by the way, that's something that's got to happen both by the private sector investing more, but also the government finding ways, to help. So, I do think that the administration's executive order to get these models is important. There's got to be coordination between the government and business on this. And I think the process will continue to get better. There are going to be more models. There's going to be more process. And, we've obviously had a team that's learning, looking, when we learn things, making adjustments, and we're going to continue to do that. But that has been a part of what we do. This might be accelerating a little bit, but it's not that different from what we've been doing for a long time. Just maybe the pace of some of the change on what these models can do is going a little bit faster. And so we've got to be more nimble, and we have the resources to do that. What I worry about is all the companies that don't have the resources to do it. And it's, by the way, it's not just financial infrastructure. Think about energy infrastructure. The biggest utility company is going to be way ahead of, the local water company in Akron, Ohio. Right. And so, everybody's vulnerable. And so we've got to figure out how to help people and bring people along.
I want to pivot. I guess we're going to run out of time soon. So I want to pivot slightly to a very important question, which is your own use of AI. Joe and I know that you're into music. You like to DJ, famously. Have you been experimenting with AI generated music?
Yeah, I mean, I've been playing with it. I've been playing with it, and what I'd say is, what I think's cool about it, as someone who's produced a bunch of music, and I want to come back to that because I think there's an important kind of lesson to learn about history in terms of music production to
Good.
where it is.
Let's go.
I think it's super cool, but what it does is it opens up the creative channel to people that would never have an opportunity to produce music. Okay. Let's just a little bit of history about music production. Because by the way, 30 or 40 years ago, I could never have produced music. Now it so happens I played an instrument when I was in elementary school and high school. I played the saxophone. I can read music. I understand music theory because I played an instrument for 12 years. When I was out of college, I would call myself a recreational drummer. I mean, I could sit on a drum set and carry a 2/4 beat and so I understand bass music theory. But, I've been a rock and roll guy forever. Like I love Bruce Springsteen. Okay. I saw my first Bruce Springsteen show in 1978, the Darkness on the Edge of Town tour. When he wrote that album, and by the way, the albums that came before and a bunch of them that came after, he sat in a studio or he sat at a piano or he sat with a guitar. He wrote notes down on paper. He wrote lyrics down on paper. He played around with it. Then he invited human beings into the studio with him that played piano, organ, drums, guitar, horns, saxophone, all different things. And they sat there and they made the music. And somebody recorded it and it got pressed onto a vinyl album. Okay. A lot of the music that we listen to today has been made on a computer on platforms called Logic Pro or Ableton, which is actually how I work to produce the music that I produced. And so if you want horns, you can choose from 150 different horns. Okay. You don't need 15 different musicians. Okay. Nobody's talked about, the difference, how technology evolved. And by the way, what it did is because Logic Pro and Ableton exist, and I'm relatively dysfunctional on the platforms, I can muddle my way around, but I need an expert to help me because they can do in 3 seconds what takes me 10 minutes. But what it allowed is for somebody to say to me, hey, I want this kind of a sound. Okay. I didn't now have to write the musical notes down. Okay. You could basically take out a piano and, say this chord sound, this chord progression, try it on the computer. You could say, I want this to be done in horns instead of in a piano. Click, it's now horns. And you can basically, put a top line together that's very interesting with a computer. A lot of the music that's produced today that we listen to is produced that way. Okay. Now what you've got is you've got an application that's basically doing that. Okay. And I think there are a couple of big issues that need to be wrestled through with this. The first is these AI apps are using other people's content in some way.
Right.
And the artists aren't getting in any way compensated, for that. And I think you've got to think about how you're going to bring the artist community and their IP, into the discussion of this over time. And, it's not gotten a lot of attention, but I think it's a very, very important thing that has to be dealt with. And secondly, this goes back to the whole discussion I had about voice when I was talking about my daughter and screenwriting.
Oh, yeah.
Okay. The stuff I produced, okay, it's my voice. I said, I like the way this sounds to me. So do it this way. I like the way this feels. So let's try it this way. Okay. And then you put it out there and you see whether or not anybody likes it. Obviously, the technology allows you to do it faster, but without a human being really then massaging it and tempering it, okay, I think you're going to get, at the moment, certainly mediocrity, and as opposed to, really, really interesting resonant stuff.
David Solomon, clearly you've given the music industry quite a lot of thought. Thank you so much for coming on Odd Lots. Really appreciate it.
Well, thank you for having me, guys, and I appreciate the conversation.
Yeah, it was fantastic.
And I appreciate you guys.
So
thank you.
Joe, that was a lot of fun.
That was a lot of fun.
A lot of fun. Kind of surprised how much thought David puts into the music industry, to be honest.
Yeah, no, I loved that you asked that last question, and I liked how thoroughly he answered it. I wasn't sure if that would be the type of thing where he's like, well, you got to focus on the banking. The thing that really struck, and there's a number of themes within the conversation that are very important to think about. But, I mean, he's really good with dates and names. And as someone who is not good with names specifically, and I'm okay with dates, I think, okay, what is I asked him that question. I was like, well, what do you have that, okay, there are other bankers and you were a producer. You get some of those. You get that sense, right? Someone who's that good at crediting the right people, knows the name, knows the days, knows what they contributed. I kind of wish I had that skill a bit more.
Yeah, you can always tell a good Odd Lots guest
Yes.
by like how many specific dates
Yeah,
and data
totally,
points
absolutely.
they actually bring up.
Wait, I know a good data point, by the way.
Oh, go on.
You-
The one.
There's one data point. So when in the music question,
Yeah.
and he mentioned having gone to see Bruce Springsteen's "Darkness on the Edge of Town" tour in 1976.
Mhm.
That was that album came out really close to the bottom in the 1970s, but this is why it's interesting because plenty of albums came out.
Yeah.
Bruce Springsteen re-released "Darkness on the Edge of Town" in 2010. So
Oh.
twice that album has been associated with sort of like generational historic lows in the
Oh, that's
market.
funny. Okay,
Yeah,
so
okay.
we'll know
That's my day.
the
That's-
crash is coming when Bruce Springsteen re-releases this for the
Well,
third
no,
time.
the next time. So
second
there's
time.
going to be at some point there'll be another crash when he re-releases it. That
That's
is a buy
the
signal.
bottom, yeah.
That's the buy signal.
All
yeah.
right. All right.
little fact I know.
Important data point here. But no, thinking about the AI
Yeah.
job situation, this is a theme that keeps coming up, which is if knowledge is commodified, if
Yeah.
knowledge and experience gets commodified on a single platform, then the human interaction, social maxing, looks maxing,
Yeah.
whatever you want to call it, seems to be getting more important.
I would actually even say there's another thing. It's absolutely true. And I would say there's probably something else, which is that, okay, like everyone gets this sort of like commodified AI
Yeah.
answer. So, okay, then you can infer that the human touch will be more important. But then you add in the fact that the last 15 years of mobile phones has destroyed so many people's like ability to like make eye
Yes.
contact that it'd probably be even more in a premium, even setting aside AI, because the skills are probably just going to get rarer as so many people lose their minds to the phone and the internet.
All right. So everyone remember to look into each other's eyes when you're speaking with someone and I guess pick up the phone
Yeah,
for,
you know-
for David's advice.
I also just thought it was really interesting that he thinks we're going to see more public companies doing private equity
Yeah.
offerings. That because I did that Alphabet headline, the Google headline, that was a big deal, and I think caught a lot of people by surprise. So the fact that it's like this is the first of multiple he expects is a very interesting
Yeah.
market trend to watch.
For sure. All right. Shall we leave it there?
Yeah, let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, Cale Brooks at Cale Brooks, and Kevin Lozano at Kevin Lloyd Lozano.
And for more Odd Lots content, you should check out our daily newsletter. You can find that at bloomberg.com/Odd Lots.
And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoyed this conversation, then please leave a comment or like the video, or better yet, subscribe.
Thanks for watching.